The Fed warns a liquidity crisis is imminent as volatility rocks stocks. I'm your host, Steven Van Metre, and thanks for joining me today. The Fed is warning that liquidity conditions are rapidly deteriorating, which could lead to a crash in stocks. Let's head over to Bloomberg, who headlined that the Fed warns of worsening market liquidity in a stability report by the Fed. The risk of sudden liquidity deterioration is, quote, higher than normal, and notable dysfunction particularly seen in the commodity markets amid the war. The Federal Reserve warned of deteriorating liquidity conditions across key financial markets amid rising risk from the war in Ukraine, monetary tightening, and high inflation in a semi-annual report published on Monday. According to some measures, market liquidity has declined since late 2021 in the markets for recently issued U.S. cash Treasury securities and now for equity index futures. And this is part of the reason why we saw bond prices fall and why equity prices are likely to fall substantially, just like bonds did. While some recent deterioration in liquidity has not been extreme as in some past episodes, the risk of a sudden significant deterioration appears to be higher than normal. In addition, since the Russian invasion of Ukraine, liquidity has been somewhat strained at times in the oil futures market, while markets for other affected commodities have been subject to notable dysfunction. And what does the Fed mean by liquidity? When you hear this, it means lack of buyers. Now, I want you to think back to the great financial crisis and what happened in the housing market when people were forced to start selling. Well, there was a lack of liquidity. There was a lack of buyers. And what happens to price when there's a lack of buyers and a lot of sellers? Well, they plummet. And that's what the Fed is warning about, that there's a sudden lack of liquidity. Of course, not that they have much to do with it, but it could lead to a crash in commodities and stocks. In a statement accompanying the release of the report, Fed Governor Lael Brainard said the war has sparked large price movements and margin calls in commodities markets and highlighted a potential channel through which large financial institutions could be exposed to contagion. So what they're referring to now is that when someone buys on margin or borrows money and buys something, when that margin gets called, if prices come down, well, all of a sudden the dealers and the banks could have to deal with it because they're the ones who lent out all the money, and well, that could spread to a lot of risk really quickly. From a financial stability perspective, since most participants access commodities futures market through a large bank or broker-dealer that is a member of the relevant clearinghouse, these clearing members are exposed to risk when clients face unusually elevated margin calls. The Federal Reserve is working with domestic and international regulators to better understand the exposures of commodity market participants and their linkages with the core financial system, suggesting the Fed has no clue what's going on. But it also faces, when you look at margin calls, as normal investors who have loaded up on debt. And here you can see this chart from Advisor Perspectives showing a negative balance in red. This is debt borrowed by investors to buy stocks. And you can see the record high, which up here, and has now come down to right here where this black line, this current level is. So dealers are also affected as stock prices come down, retail investors get margin calls, and they too are forced to sell, which could have a major impact on the dealer networks. The S&P 500 index of stocks tumbled Monday to the lowest levels in more than a year and is now almost 17% below the record high set on January 3rd, putting that nearly in a bear market. The decline in asset prices has coincided with a move toward sharp monetary policy tightening by central banks around the world, including the Fed, to address ongoing inflationary pressures. And suddenly we find out perhaps the real truth here, this lack of liquidity is due to the Fed withdrawing their easy monetary policy and leading to tighter financial conditions, which, as we've seen in the past, is exactly what happens when the Fed goes from easing to tightening. Elevated inflation and rising rates in the United States could negatively affect domestic economic activity, asset prices, credit quality, and financial conditions more generally. It has also called out U.S. house prices, which said could be particularly sensitive to shocks given high valuations. So as you can see, the Fed is suggesting that, well, everything could come crashing down. And if there's one thing that shouldn't be subject to a financial shock due to elevated volatility, that's your portfolio. Be sure to check out Portfolio Shield. I'll put a link up here in the corner in the description below. Now let's continue on, because the Fed, well, they think perhaps a recession might even be in the cards. Former Fed officials warn recession may be necessary to tame inflation, as they voted unanimously last week to increase the federal funds rate by 50 basis points. The critiques were made by Fed's two most recent vice chairs. Richard Clarida, until January, served as a vice chair for monetary policy formation, and Randall Quarles, a Trump appointee who oversaw banking regulation until the end of 2021. Their comments come as the Fed races to catch up with inflation, which is set at a 40-year high by aggressively tightening monetary policy. Quote, the effect is likely to be a recession given the intensity of inflation and the degree to which unemployment has been driven down, Quarles said last week at a recent podcast. It's unlikely the Fed is going to be able to manage that to a soft landing, something that I've said is highly unlikely. The Fed's historical track record of managing a soft landing, well, is pretty low, and this time seems highly unlikely that they're going to pull it off. That sentiment was echoed by Clarida, now an economics professor at Columbia University, who said the Fed will need to raise the key rate well into restrictive territory to cool consumer demand, slow economic growth, and curb inflation. However, as we're going to look at here shortly, the stock market may actually do that for them at a much faster rate before the Fed even gets policy rates that high. Powell has acknowledged there could be some pain associated with reducing inflation. Well, that's an understatement of what's to come, and curbing demand, but pushed back against the notion of an impending recession, identifying the labor market and strong consumer spending as bright spots in the economy. And don't worry, there's never will be and never has been a Fed chair that will call out and say that a recession is coming. They will literally stand on the ship as it sinks, telling people that it's not going down. But that leads us to, again, now why is the stock market going down? Perhaps it is due to all this withdrawal of liquidity, and what that means for the economy? Well, let's take a look. As the New York Times headlines, the stock market's plunge continues on new concerns about the global economy, not to mention the lack of liquidity, as Wall Street's relentless decline stretched into a 6-week on Monday, fueled by new data from China that added to concerns about a global economy we talked about on Monday that's being battered by high inflation, rising interest rates, and a malfunctioning supply chain. The S&P 500 fell 3.2%, adding to the downdraft that's put it nearly into a bear market. The drop in stocks approaching a bear market as Wall Street's term for a decline is 20% or more from recent highs. Investors have a long list of reasons to back away from stocks right now, although retail investors are buying dips like crazy as rising prices and higher interest rates are sure to hurt consumption in the United States, while the war in Ukraine and the lockdowns in China are hampering supplies of everything from food to energy, exacerbating the inflation problem. But really what's going to happen is the stock market's going to do the heavy lifting. It's going to cause a lot of damage. Now let's take a look at this chart of advanced retail sales on a year-over-year rate of change and the Wilshire 5000. Again, if you're not familiar with this, it's just the total U.S. stock market also on a year-over-year rate of change. So what you'll notice is when the stock market starts to slow down and goes negative over the prior year, and you'll see it here and going into the dot-com bubble, the great financial crisis, we're starting to see that now. We've seen a few other times. Notice what happens to retail sales. They start to slow. They start to slow, in this case, contract. We see a stock market come down, retail sales slow. And all that tells you is when the wealth effect goes away, well, then retail sales slow down, the economy slows down. So in this case, this lack of liquidity driven by the Fed is doing all of the heavy lifting and probably going to keep them from raising rates too much more. Let's continue on, as conversely, any sign that inflation is easing, allowing the Fed to consider slowing its campaign to raise interest rates would help allay concerns. Annual inflation reached 8.5% in March, its fastest pace in over 40 years, with food and fuel driving prices higher, as economists expect the price gains will slow slightly when the data for the CPI is released on Wednesday. 1 month of better data probably won't be enough to calm the markets, but it could be a start. And certainly enough, we heard from Fed Chair Powell that 1 month isn't enough. But is the stock market going to do that heavy lifting for them? Well, let's take a look, because now let's take that same chart with the Wilshire 5000, remove retail sales, and overlay consumer price index on a year-over-year rate of change. And we'll note that when the consumer price index in blue gets real high and the stock market starts to come down, that wealth effect eventually transmits into lower consumer prices or slower consumer price growth. We can see that happening here. The stock market starts to come down against rising inflation, and inflation comes down. We see inflation rising, stock market start to slow down its rate of change, and inflation goes away. And why is that? Again, and we see that here, inflation high, stock market coming down, and it's a real simple answer. It comes back to that wealth effect that central bankers know about. Of course, Alan Greenspan was the first central banker to really coin that term and use that to drive stock prices higher to keep the economy going. But without the wealth effect, consumers stop spending, demand goes away, and next thing you know, we're in a recession. The bottom line is that markets don't like uncertainty, and the current macro environment is tenuous at best. Any positive developments on the geopolitical front or softer than expected inflationary readings could help abate the recent selling pressure. Unfortunately, we're seeing a lot of margin calls from retail investors as prices continue to fall. No matter when it ends, there's no question that recent stretch of volatility has stood out in a market that for years was remarkably placid, and here you can see the Cboe Volatility Index at the VIX sitting at those two lines, the 31 and 36, and notably when it breaks over that green line where it hits 36, volatility gets unleashed, and we are very close to a liquidity crisis here and a vol shock. And what's interesting is due to a lack of buyers, we could see a substantial sell-off in the markets at a time where the Fed may not be in a position to respond. I'm your host, Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.